So which is truly the better way to get rich? And I'm not talking about having a couple $100,000. I'm talking about millions. What is the best way today to get rich? A lot of you are probably thinking the stock market, investing in stocks and ETFs and companies that take off, and I will agree with you. But what about real estate? I consistently go back and forth on if I want to own a lot of real estate or if I want to just rather throw that money into the stock market and see how it trades. So today we're going to meet in the middle. I'm talking about a NEOS fund that is not nearly as popular as I think it should be, ticker IYRI. It's a mouthful, it's not easy to say, but I promise the returns are very, very interesting, and I think you're going to want to see them. So we're going to hypothetically invest $10,000 and track our returns over the next 10, 20, or 30 years and see if we can match up to the stock market or to the real estate market over these time periods. So I hope you guys do enjoy. If you're interested in this style of content on ETFs, on stocks, on making money in the stock market, don't forget to like and subscribe so you never miss the free updates. Thank you guys so much. We're working on growing this channel as well, so I really do appreciate it. Let's get into the video. Using cruisebank.com, we can actually see, charting from 2007 to 2022, how the performance of the S&P 500, which is some of the top 500 companies available in the stock market, how it compares to real estate. And we actually see the S&P 500 pretty well outperform with a 393% return compared to 256% from real estate. But if we slide down even more, we see another interesting chart. Let me zoom in on this. And what we're looking at here is the same style of chart, but it showcases different times of just the market overall, different year segments, a couple 4 to 5 year differences, and it goes all the way back to 1992. And here we actually see real estate outperforms, not significantly, I would say, but it outperforms the stock market. And I am curious to see how this does in 2025 because the stock market is reaching new all-time highs, and I feel like real estate is not. Maybe it is. Let me know what you guys think. But very interesting, a 2,161% return compared to 1,869.5% return. So really, it's relatively neck and neck. You always have to pick your time in the market for both. But there's only been a couple of times where real estate has fallen below the stock market, most in the last couple of recent years. And now my thoughts on this, it's interesting. We're seeing the housing market become more and more unaffordable for most people. And stocks will always be a vessel in which anyone can invest. You don't have to have a minimum amount. I mean, maybe $5 or something. But I am curious how this plays out over the next 20 years. And so what I'm really interested in with using this REIT-based income ETF, how it can compare. So we will compare it at the end, and we'll see exactly how much we can make within a certain time frame. But let me know what you guys think about this chart. Isn't this a little bit scary to see? I don't like how expensive housing is getting, but I do love that our stock market is doing well, and I hope that that trend does continue. For ticker IYRI, it's the NEOS Real Estate High Income ETF. Distributes monthly, expense ratio 0.7%, which is a factor. That's pretty high, I will say, and a distribution rate of 11.3%. What I like about this is you are probably getting a little bit lower implied volatility, but it should be a little more steady. When comparing it to SPYI or QQQI, IWMI, I think it'll be a little bit more consistent, but that can be a downside if we're looking at a really good market, which it seems like we are. But their benefits seeks to distribute high levels of monthly income through data-driven call option strategy on ETFs that seek to track the Dow Jones U.S. Real Estate Capped Index. It's actively managed by NEOS, hence a more expensive fund to hold. Seeks to offer upside potential in addition to the primary objective of high monthly income. So we have growth, we have income. Sometimes we have a bit of both, but the point of IYRI is that income. Thirdly, we can see the fund may offer efficient exposure to a portfolio of U.S. listed REITs. Very interesting, because I love REITs myself, with an enhanced layer of high monthly income potential packaged into a single ETF. And guess what? It makes sense. It sounds cool. We're paying for it with that expense ratio. So sliding down, we can actually see their distribution frequency. It's interesting, ranging about 50 cents. And sliding down even further, we can see what they hold. So American Tower Corp, this is like it's like cell phone tower company, AMT, I believe it is. And then we have Prologis, we have Welltower, we have Digital Realty Trust, Equinix, Realty Income, a very popular REIT, Simon Property Group, so many good ones. Crown Castle's another tower, another cell phone tower company. And these are all relatively split. Oh, see, here's the identifier, AMT. So they're weighted all the way 7.6% for AMT. And I think you will get a little bit of decent growth with this portfolio as well. Lower on realty income. It's just a lower risk, lower yielding fund, I should say stock with about a 6% yield, but some good ones and some big names in here. So I am curious. We're going to throw all of this into our calculator for a 10K invested and see how it tracks with our other returns, of course, from just overall stock market and overall real estate, and see if this fund is even worth looking into. I think throwing this into a drip calculator is going to showcase exactly how it has been performing. We've seen a total of 5.43% in return. While that's not crazy, that's not for a full year. A full year annualized, it's going to be about 11%, which is about what it boasts. And now these funds are not supposed to be get rich quick. They're really not. It's growth, it's income focused. And if you have drip on or dividend reinvestment on, you can continue growing that position. If not, you can use the dividends for, let's say, something monthly like a mortgage, a car payment, or even just extra money to have at the end of every month, which I think is really cool. But I like this style of IYRI because you are holding real estate assets technically. It's capped in the sense that you won't have more than 10% into one of the underlying REITs. But with a lot of these income ETFs, whether it be MSTY, PLTY, you're not holding the underlying. But here, you're holding the underlying ETF, right? The US Dow Jones. So, well, their real estate portfolio. So it's really cool how this is actually working. It gives you a piece of real estate and you will get some of that price appreciation as well as some distributions, which I think is phenomenal. And it's definitely the goal. And I think with drip turned on, you could do really well. And even with drip not turned on, you can start making some pretty consistent gains on real estate. Now we are going to use our drip calculator and compare VNQ, or the Vanguard Real Estate Market ETF, to the S&P 500. And what we're looking for here is our average annual total return. So we'll blow this up and we're going to factor in with drip on. And this is already very, very interesting. So we see SPY outperform. VNQ was started in 2004. So anything earlier than that, it's not going to cap, but it's about 20, almost 21 years. So in that time span, we have seen VNQ averaging 7.23%, which is underperforming the stock market by a pretty significant margin. I mean, we can see SPY at 10.51%. Now your 10K for VNQ would be worth $42,700, where SPY would be $79,900. And what's key here is both of these are underperforming IYRI. It's sat at an 11% average annual total return, although it again is still very new. So we don't know how it's going to perform over a longer time frame, but it's very interesting. VNQ only at 7% with drip on and SPY at 10.51%. Now VNQ isn't really necessarily a dividend focused, I would say. It depends on the underlyings, but still, we had some good dividends paid out, and there's a big significance between the dividends paid out with drip, because we can see $63.7 in dividends from VNQ and $85.9 from SPY. So it even paid less in dividends than the S&P 500. So all in all, very interesting. So we're going to throw our 11.01% into a drip calculator and see if IYRI is the ultimate cheat code to getting rich. I do wonder with this calculation how it would compare if you were just really good at picking properties, or potentially if you purchased properties and rehabbed them, if you were good at stuff like that. Because that's where I get locked in with real estate, because I like doing that. I like home projects. I'm not the most handy person in the world, but it's fun to learn that kind of stuff. But now we're just going to throw IYRI in our calculator and see what it would make us over 10, 20, 30 years with our 11.01%. Because that's what we saw with our drip calculator. Now I have everything plugged in. Monthly drip is turned on. Number of shares, share price. We're not adding anything annually. We're starting with 10K and letting it ride. We're not going to be taxed. We'll say it's in a Roth IRA or a tax exempt account. We're also not increasing the dividends or share price. So even if we do see some share price upside, we're not going to factor that in, just to be kind of on the safe side and just focus on the yield. Now, when I plug in 1 year, of course, it's going to be slow to start. We can see our first year, our $10,000 is going to get us $1,158 in dividends, which is great. Moving forward, our next year, we're going to make just about $1,300 in dividends because that drip is on. But 1 year isn't, it's good, but we need some time to really let this thing cook, right? 5 years. After 5 years, we can see our $10,000 investment would be worth $17,300. We would make $7,300 in distributions, which is pretty wild. Now, again, that is over the 5-year period. We're only getting a couple thousand annually, but that's still very solid. Moving forward, we're going to make $2,000 every single year. And now that might not be a ton of money. For some, it is a lot of money, and that could really help with some bills. moving up to 10 years. After 10 years, your $10,000 is now worth $29,000, and our total dividends paid is almost $20,000. So imagine making $20,000 just sitting on just one investment. We can also see a total return of 200% now, which is pretty phenomenal. And we're going to just keep seeing this go. If we jump up to 20 years, we're now at $90,000. We've made $80,000 in dividends, and we had our 10K initial investment. Moving forward, we're going to get 10K every single year. And again, this is not something that you can quit your job only having $10,000 invested for 20 years, especially with inflation and other factors, but it's something to note. Kicking it all the way up to 30 years, let's see if this is going to help us in retirement. Wow. Our principal has grown amazingly. We've got a 2,600% total return, and our ending balance is sitting at just under $268,000. Very impressive. We've made most of that in dividends, of course, and our annual dividend income is $31,000. Now, I know what you guys are thinking. $31,000, you can't even live off that now. Why would we try and live off that in the future? Well, hopefully you'd have other investments tied in with this. You'd have stocks, you'd have maybe even physical real estate tied in with this, and this is just another boost. But can we live off of this? If we were to jump to 40 years, let's say you're 20, you have 10K, you throw it into IYRI, and you let it sit for 40 years. Are we able to retire on just the dividend income alone? Because that's my goal. I genuinely want to retire on my dividends one day. And wow, who knows what the next 40 years are going to be like with inflation, but this is impressive. You could definitely retire on it this day and age. We can see your ending balance is $801,000. Total return of just over 7,900%. And our total dividend payments are just, again, under $800,000, which is crazy. But here's the kicker. Your annual dividend income moving forward is $93,000. If you're in a Roth IRA and it's tax-free, boom, there you go. If you're going to take it out and live on this income, you will be taxed on it, unfortunately. But our initial money that we've made, our $800,000, we can pull out tax-free. We don't want to take that money out because we want to live off the dividends alone. But this is really interesting, and it's a different style of income ETF that not a lot of people are talking about because the income space right now is so aggressive, and there's a lot that are paying out crazy high. But will it last? Only time will tell. I hope you guys enjoyed this video. If you did, check out the ones popping up on your screen right now, including this one on the Hidden Neos Fund no one is talking about that I think people should definitely know about. It's definitely unique. And let me know what you think in the comments about IYRI. Don't forget to like and subscribe, and I hope to see you in the next video.